Imagine losing your home, your savings, and your job, all in just a few months.
That's what happened in 2008, when the financial world collapsed almost overnight.
But how did it happen, and who was really responsible?
Let's dive into the 2008 financial crisis and understand the story behind the numbers.
The 2008 financial crisis was the worst economic disaster since the Great Depression. Banks failed, stock markets crashed, and governments had to step in to prevent total collapse. But to understand why it happened, we need to go back a few years. It all started with the housing bubble in the United States. In the early 2000s, banks were giving mortgages to almost anyone, even people who couldn't afford them. These risky loans were called subprime mortgages. Investment banks bundled these mortgages into complex financial products called mortgage-backed securities, or MBS. These were sold to investors all over the world, from Wall Street to Asia. Everyone believed housing prices would keep rising forever. But when prices started falling in 2006 and 2007, the whole system began to unravel. Banks and investors realized they were holding huge amounts of toxic debt. It was the beginning of a financial storm no one could stop. And the first domino was about to fall. The world was about to witness one of the biggest collapses in history. Homeowners defaulted on loans. Mortgage-backed securities lost value fast. Banks that invested heavily faced massive losses. Lehman Brothers, one of the biggest banks, couldn't survive. It declared bankruptcy in September 2008, causing panic across global markets. Other banks teetered on the edge of collapse. Governments had to step in with bailouts worth trillions of dollars. The world was watching, fearing a total economic meltdown. It was a crisis that no one could ignore, and the impact would reach every corner of the globe. The crisis wasn't just about numbers, it affected real people. Millions lost their homes, jobs, and savings almost overnight. Retirement accounts and pensions shrank, leaving many uncertain about the future. Families struggled to survive, and unemployment soared. Businesses closed, and the fear of another depression hung over the world. The 2008 financial crisis showed that no one is safe from the ripple effects of a financial collapse. Governments acted quickly to stabilize the system. Central banks injected massive amounts of money and lowered interest rates. Stimulus packages were introduced to save struggling businesses and households. It took years for the economy to recover, but new rules were introduced. Banks now hold more capital, and regulations were strengthened to prevent another crisis. The 2008 financial crisis taught the world three major lessons. Lesson 1: risky loans and over-leveraging can collapse the entire financial system. Lesson 2: transparency and regulation are critical to prevent disasters. Lesson 3: economic crises affect everyone, not just banks or investors. By understanding these lessons, we can make smarter choices with money, investing, and risk. While we can't prevent every crisis, we can be better prepared for the next financial storm.